Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at advanced micro devices.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our analysis. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We're looking at a company undergoing, well, a really significant transformation. Maybe one of the biggest in tech right now.
A transformation is putting it lightly.
Right. They're shifting from being this, cyclical vendor of CPUs and GPUs.
Totally reliant on the PC and console cycles.
Exactly. To becoming this vertically integrated leader in AI compute. A totally different kind of company.
Okay, let's unpack this. We've all heard the AI story, but you need financial proof. What does the performance lately actually tell us about that shift? Is the AI revenue real?
Oh, it's real. And the financials, they really bear that out. If we look at the last reported quarter, revenue was $5.77 billion.
Which is solid growth, right?
22% year-over-year growth. So yes, it beat what everyone was expecting. But that's just the headline. The really critical detail is the margin expansion.
Right, because margins expanding like that means they're selling better stuff, not just more the same old thing. Yeah. What were the numbers there?
So the non-GAAP gross margin hit 55.8%.
Wow.
For context, that's a 270 basis point expansion from the year before. A huge lift.
And that's almost all coming from the high-margin data center products.
Overwhelmingly.
Yeah.
The product mix is skewing dramatically toward the MI300X accelerator.
So the data center is basically pulling the whole company up. Are there any other levers helping those margins?
Yes, efficiency. Big time. They're getting these huge gains from their migration to the TSMC 3-nanometer process node.
Which for our listeners means smaller, more powerful, and more efficient chips.
Exactly. It all comes down to performance per watt. For the big cloud providers building these massive AI data centers, power is a huge cost. So better efficiency means a lower total cost of ownership for them.
Okay, that's the short term. The engine is running. But for investors, it's about the long-term vision. What are they actually telling the street to expect?
Management's long-term framework is probably the most ambitious one out there right now. They are targeting a greater than 35% company-wide revenue CAGR.
35% CAGR. For a company this big, that's extraordinary. But what about the bottom line? Earnings per share.
This is the number that really makes you stop and think. They are aiming for greater than $20 non-GAAP EPS over that plan horizon.
$20.
$20? To put that in perspective, getting to that level would mean a massive multi-bagger return from where the stock is today. The market is not pricing that in, not even close.
So over $20 EPS, that is the bull case in one number. And the engine driving that, as you said, is the data center. How aggressive are they targeting that specific segment?
Within that big plan, the data center segment is targeting an astonishing greater than 60% revenue CAGR.
Yeah.
And for AI specifically, the Instinct accelerators, they're aiming for over 80%.
An 80% CAGR. So basically 8 out of every 10 new dollars is coming from these AI chips. Do we have concrete proof of adoption? Are customers actually buying at scale?
They are definitely past the pilot stage. The MI300X GPU shipments, they topped 1.1 million units in the last quarter. That's not a test run. That's industrial scale adoption.
And who are the big buyers?
The biggest spenders in AI. You've
Really?
got Microsoft Azure, Oracle. They're all embedding the MI300X in their next-gen AI clusters.
And the really big one you mentioned was OpenAI. What does their involvement signal?
It signals legitimacy. We know OpenAI is deploying 6 gigawatts of their GPUs. This shows real, decisive traction in the most demanding AI training environments, the kind of place that needs the absolute best silicon.
Okay, here's where it gets really interesting and where they've struggled in the past. The software barrier. For years, their competitor's CUDA platform has been this impenetrable fortress. How are they breaking through that?
That fortress is, it's starting to crumble. Their strategy is dual track. It's about the hardware IP, but also the software ecosystem. They've been pushing their ROCm 6.0 platform.
And what's the headline figure for ROCm?
It now supports 95% of key PyTorch and TensorFlow models.
And that's crucial. For our listeners, those are the foundational languages of AI.
Exactly. By getting to near parity on model support, they are fundamentally undermining that legacy software lock-in. Developers now have a credible open-source alternative.
So if the software is now close to parity, the decision for a big cloud provider becomes about economics. It's about performance and total cost, not just software necessity.
That's it. And once they get a win, the switching costs become enormous. Once the MI300X is embedded in a huge cluster, the cost for that customer to switch back could be over $1 billion. It's just not practical. It makes these early contracts incredibly sticky.
And we're seeing this traction outside of just the big cloud players, right? You mentioned government adoption.
We are. Winning 5 out of 7 new U.S. government AI contracts last year is a huge validation point. It shows they're trusted for stable, secure, mission-critical workloads.
And we also need to remember, it's not just about the data center and the AI gold rush. They have a breadth to their portfolio that their rivals just don't.
Absolutely. Their true moat is that full portfolio. You have the CPUs, the GPUs, and the adaptive computing from the Xilinx acquisition. They expect to exceed 70% share in those adaptive and embedded segments.
What about their server CPU business, EPYC? Is that still a growth driver?
A critical one. They're targeting greater than 50% server CPU revenue share with EPYC, really leveraging their performance per watt advantage. This multi-product platform is key to them capturing the whole compute market.
So the fundamentals are there. The engine is running. Let's look at the market psychology. What are the charts telling us?
Well, the stock has been volatile, for sure, but the underlying technical structure looks constructive. It suggests this is just consolidation before the next move up.
What specifically are you seeing?
The weekly chart recently confirmed a classic bullish cup and handle pattern. It broke out above the prior high of around $195 with significant volume. That breakout really suggests sustained institutional confidence.
So a pause, but within a bigger bull trend. What about momentum indicators?
They're confirming that. We saw a golden cross earlier this year. That's the 50-day moving average crossing above the 200-day. It's a classic signal that the intermediate trend is now definitively bullish.
Okay, so the chart structure is positive. Let's talk money flow. Are the big institutions still buying in?
The flow is very constructive. Funds like BlackRock, Fidelity, Vanguard, they showed net institutional buying of 21.4 million shares in the latest reported quarter. That's serious capital.
And what about the insiders? What is management doing with their own money?
They're buying. Executives bought $12.8 million in shares early this year. When the people running the company are putting their own money in at these levels, it's a powerful signal.
That sets the stage perfectly.
Yeah.
So looking forward, what are the catalysts? What could trigger the next big move?
The main near-term focus is the next earnings release. That's expected in late July. Everyone is watching for two things: data center revenue guidance and confirmation that the MI300X ramp is accelerating even faster than people think.
Any new products on the horizon? The AI chip cycle moves incredibly fast.
Yes. There's new iron coming down the pipeline very quickly. They just unveiled the MI325X accelerator back in April. This thing boasts an astonishing 2.5 terabytes per second of HBM4 bandwidth. Just blisteringly fast.
And are we seeing adoption for that already?
We are. Microsoft has already announced plans to deploy the MI325X in Azure AI clusters later this year. That kind of quick adoption from a major player is a huge vote of confidence.
And what about the bigger picture? The macro environment, geopolitics.
Those are massive potential catalysts. First, you have rate cut expectations. If the Fed starts cutting, capital gets cheaper, and that makes all these future growth stories more valuable today.
And geopolitics.
That's the wild card. The market is incredibly sensitive to U.S. export policy on AI chips to China. Any kind of conditional approval for sales there, or even expanded licenses to other markets like Japan or South Korea, could unlock a huge new market.
Okay, we have to stay balanced. Let's talk about the risks. What are the potential headwinds here?
The primary risk is always going to be competitive pressure, specifically from NVIDIA's next-gen platforms. There's a lot of chatter that they could undercut MI300X pricing by, say, 15 or 20% to protect their market share.
That kind of price war could really hurt those margins you were talking about. What's the counter argument?
The counter is that total cost of ownership we mentioned before, the lower power draw, and the contract lock-in. Once a hyperscaler like Microsoft commits, the cost to switch is just massive, so demand isn't just about the sticker price of the chip.
Makes sense. They get embedded and they're hard to remove. What about supply chain issues? Everyone is fighting for wafer capacity right now.
It's an inherent risk, for sure. Delays at TSMC on the 3-nanometer node are a real concern. It could constrain their output.
So what are they doing to mitigate that?
They've been proactive. They've secured multi-sourcing agreements, and the last reports actually showed their wafer allocation exceeded their own internal targets. So yes, the risk is there, but they seem to be managing it very effectively.
So when you put it all together, it sounds like the risks are real, but manageable, and maybe already priced in, leaving a lot of room for that growth story to play out.
I think so. If you connect this to the bigger picture, they are positioning themselves as the leading alternative and really the only open ecosystem choice in a trillion-dollar market. You have the combination of financial rigor, those huge EPS targets, clear share gains, and a very active Catalyst calendar. It's just a uniquely compelling multi-year growth story.
This raises an important question for you, the listener. If Advanced Micro Devices successfully executes on its plan to become the structural open-source alternative and hits those long-term targets of over $20 EPS, how much of that truly revolutionary growth potential is captured in the stock price today? That's something to mull over as you assess your portfolio strategy. We highly encourage you to subscribe to Smart Wealth with Joshua so you don't miss our next analysis.